How short sellers are betting against office landlords by using credit derivatives and equities to profit from their declining stock prices and debt ratings. Short sellers are investors who borrow shares of a company and sell them in the hope of buying them back later at a lower price, pocketing the difference. They are usually betting that a company will perform poorly or face some challenges that will hurt its value. One of the sectors that has attracted a lot of short sellers lately is office real estate. Office landlords are owners of buildings that lease space to businesses and other tenants. They make money from collecting rent and increasing the value of their properties. But office landlords have been hit hard by the pandemic, which has forced many workers to stay at home and reduced the demand for office space. Many tenants have asked for rent relief, renegotiated leases, or moved out altogether. Some have gone bankrupt or defaulted on their loans. Office landlords have also faced rising interest rates, which make their debt more expensive and lower the value of their properties. And they have been affected by the regional banking crisis in the US, which has reduced the availability of credit for commercial real estate. According to Goldman Sachs, regional banks account for about 80% of bank lending to commercial properties. But 3 regional banks have failed in the US, raising concerns about the implications for commercial real estate finance. Many lenders are losing deposits, which might cut into their ability to finance real estate in the future. Short sellers are taking advantage of this situation by using 2 main strategies: credit derivatives and equities. Credit derivatives are financial contracts that allow investors to bet on the creditworthiness of a borrower or a group of borrowers. One type of credit derivative that short sellers use is called CMBX, which stands for Commercial Mortgage-Backed Securities Index. CMBX is an index that tracks the performance of a basket of bonds backed by commercial mortgages. These bonds are issued by lenders who pool together loans made to commercial property owners, such as office landlords. The bonds pay interest and principal to investors based on the cash flow from the underlying loans. But if some of the loans default or become delinquent, the bonds lose value and the investors lose money. That's where short sellers come in. They can buy protection on CMBX using credit default swaps (CDS), which are contracts that pay out if a bond defaults or suffers a credit event. By buying protection on CMBX, short sellers are betting that some of the loans backing the bonds will go bad and trigger payouts on their CDS contracts. They can then use those payouts to buy back the protection at a lower price, making a profit. Short sellers can also target specific office landlords by using equities, which are shares of a company that represent ownership and claim on its earnings and assets. By borrowing and selling shares of office landlords, short sellers are betting that their stock prices will fall as their business suffers from lower occupancy, rent, and property values. They can also benefit from dividends paid by office landlords, which they can use to cover part of their borrowing costs. Some of the office landlords that have seen a surge in short interest include Hudson Pacific Properties Incorporated, Vornado Realty LP, and iShares US Real Estate ETF. Short interest is the percentage of shares outstanding that are sold short. Short sellers face some risks and challenges in their bets against office landlords. One is that they have to pay fees and interest to borrow shares or buy protection on CMBX, which can eat into their profits. Another is that they can lose money if the stock prices or bond values of office landlords rise instead of fall, forcing them to buy back their positions at a higher price. Moreover, short sellers may face regulatory or legal actions from authorities or companies that accuse them of spreading false or misleading information to manipulate the market. They may also face public backlash or criticism from investors or analysts who disagree with their views or motives. But short sellers believe that they are providing a valuable service to the market by exposing the weaknesses and risks of office landlords and by creating more liquidity and efficiency in pricing. They also argue that they are expressing their opinions and exercising their rights as investors. In summary, short sellers are betting against office landlords by using credit derivatives and equities to profit from their declining stock prices and debt ratings. They are taking advantage of the challenges faced by office landlords due to the pandemic, rising interest rates, and regional banking crisis. But they also face some risks and costs in their bets, as well as potential opposition from regulators, companies, and other market participants.